Welcome to our session on ETFs, where we delve into the fascinating world of creation and redemption. This technology is central to how ETFs operate, involving two distinct markets, the primary and secondary markets. For most investors, the action happens in the secondary market, where ETFs are traded on exchanges. However, the process of creating and redeeming shares takes place in the primary market, and it's exclusive to authorized participants who have special agreements with the fund. Let's explore how this mechanism works. When investors trade on an exchange, they might be dealing with other investors, or more commonly with a market maker, who ensures liquidity in the ETF market. This market maker sets the ETF's price based on its fair value, which reflects the cost of buying or selling the underlying assets. This is known as the arbitrage mechanism. Consider the process of creation. When market makers have sold more ETF shares than they hold, they need to balance this by creating new shares. They do this by delivering a basket of underlying assets to the fund at the end of the day. The fund then issues new ETF shares to the market maker, thus neutralizing their short position. This is how new shares are introduced into the fund, a crucial back-office function based on the net asset value, NAV, of the fund. On the flip side, we have redemptions. When investors sell ETF shares, market makers buy them and hedge by selling the underlying basket. If the market maker ends up with excess ETF shares, they can approach the fund as an authorized participant to redeem these shares. The fund then retires these shares and returns a proportional share of the fund's assets to the market maker, thus balancing their position. This process underpins the tax efficiency of ETFs, as it avoids triggering capital gains events within the fund. Another key aspect is the cost insulation for investors. In ETFs, market makers set the price around the fair value, including a spread that reflects the transaction cost in the underlying market. This contrasts with mutual funds, where portfolio managers directly handle transactions within the fund, affecting all investors through a reduction in NAV. Thank you for joining us in this exploration of ETFs. We hope this session has enhanced your understanding of what ETFs are, how they differ from mutual funds, the various types available, where they can be bought and sold, and the fundamental workings of an ETF structure.